There's a number that defines our future more than any election, more than any war, and more than any technology. It is a number so large that the human brain struggles to comprehend it. $38 trillion. That is the gross national debt of the United States of America. To put that in perspective, if you spent $1 million every single day since the birth of Jesus Christ, you would not have spent even $1 trillion by today. The United States owes 38 times that amount. For decades, politicians told us that debt doesn't matter. They told us that we owe it to ourselves. They told us that as long as the economy grows, the debt is harmless. They lied. We have now crossed a mathematical event horizon. Today, the United States government spends more money paying interest on its old debt than it spends on its entire national defense. It spends more on interest than it does on health care for veterans. The debt is no longer a tool, it is a predator. It is consuming the economy from the inside out. This is not a political opinion. It is an arithmetic certainty. The trajectory we are on leads to one of three outcomes: a catastrophic default, a brutal austerity that guts the social safety net, or a hyperinflationary collapse that destroys the value of the dollar. Welcome to the Financial Coin Historian. Today, we are presenting the definitive investigation into the U.S. national debt crisis. We will tear apart the balance sheets. We will look at the bond trick the Federal Reserve uses to keep the game going. We will analyze the historical precedents of Rome, Spain, and Britain to show you exactly how empires die when they can no longer pay their bills. And most importantly, we will show you what this means for you, for your savings, your house, your grocery bill, and your children's future. The bill is coming due, and you are the one who has been drafted to pay it. To defeat an enemy, you must first understand it. What exactly is this $38 trillion debt? Is it just money we owe to China? No. The reality is far more complex and dangerous. The national debt is the cumulative total of every deficit the federal government has run since the founding of the republic. It is the sum of every war, every bailout, every tax cut, and every social program that was not paid for with cash on hand. Debt held by the public versus intragovernmental debt. We must distinguish between two types of debt. First, there is debt held by the public. This is about $29 trillion. This is the debt owed to individuals, corporations, the Federal Reserve, and foreign governments. This is the debt that trades on the open market. This is the debt that determines interest rates. Second, there is intragovernmental debt. This is about $7.3 trillion. This is money the government owes to itself, specifically to trust funds like Social Security. Here's the dirty secret. For years, the government collected Social Security taxes from your paycheck. But instead of sitting in a vault, that money was spent. It was spent on wars, on roads, on general budget items. In its place, the Treasury put an IOU, a special non-marketable bond. So, when politicians say the Social Security Trust Fund has trillions of dollars, what they really mean is that it has trillions of dollars of IOUs from a government that is already broke. When the baby boomers retire, which they are doing right now, the government has to find the cash to redeem those IOUs, but the cash isn't there. It has to be borrowed. This is why the debt is exploding now. The demographic bill has arrived. Who owns America? There's a myth that China owns the United States. While China is a major creditor, holding hundreds of billions in treasuries, the reality is that the biggest holders of U.S. debt are domestic, the Federal Reserve. The central bank printed trillions of dollars to buy government bonds, especially after 2008 and 2020. This is their bond trick. Monetizing the debt to keep interest rates low, pension funds and mutual funds. Your retirement account is likely filled with U.S. treasuries. If the debt collapses, your 401k collapses. Foreign investors. Japan and the UK are also massive holders, but their appetite is waning. As the US weaponizes the dollar through sanctions, foreign nations are diversifying into gold. If they stop buying, who will fill the gap? Why can't we just stop borrowing? Why can't we balance the budget like a household? Because the budget is no longer discretionary. We are living in an era of structural deficits. The shift to mandatory spending. 50 years ago, most of the federal budget was discretionary, meaning Congress voted on it every year. Defense, education, infrastructure. Today, the vast majority of the budget is mandatory. These are payments required by law: Social Security, Medicare, Medicaid, and interest on the debt. Mandatory spending totaled $4.1 trillion in fiscal year 2024. That is more than the entire revenue of the government in some years. This means that even if we cut the defense budget to zero, even if we fired every federal employee and closed every national park, the U.S. government would still be running a deficit. The interest spiral. This is the most terrifying feedback loop. As the debt grows, the interest payments grow. As interest payments grow, the deficit grows. As the deficit grows, the debt grows. We have entered a debt spiral. Under recent interest rate hikes to fight inflation, the cost of servicing the debt doubled. We went from paying $350 billion a year in interest to over $880 billion. And now we are crossing the $1 trillion mark. Think about that. $1 trillion a year. That is wealth being transferred from taxpayers to bondholders. It buys no roads. It educates no children. It defends no borders. It is simply the cost of past mistakes. And it is crowding out everything else. You might be thinking, this is Washington's problem, not mine. But you are paying for it every single day. The debt is not free. It is paid for through the invisible tax of inflation. The $18,000 hit. When the government spends trillions it doesn't have, the Federal Reserve prints the difference. This flood of new money dilutes the value of the dollars in your pocket. This is the classic Cantillon effect. The government gets the money first, you get the higher prices later. Since the massive spending spree of 2021, the cost for the average family of four to purchase the same goods and services has increased by over $18,496 per year. Food prices up 22%, gas prices up 32%, rent up 24%. This is not corporate greed or Putin's price hike. This is the direct mathematical result of increasing the money supply to fund the national debt, the wealth destruction. Long-term economic modeling shows that if this debt trajectory continues, real household wealth will decline by $36,000 per household over the next 30 years. Why? Because government debt sucks up all the available capital in the economy. This is called crowding out. Instead of money going into new businesses, factories, and technologies that create jobs and wealth, it goes into buying treasury bonds to keep the government afloat. The result is a stagnant economy, lower wages, and a lower standard of living for you and your children. We have seen this movie before. The plot never changes. Rome, the denarius debasement. In the 3rd century, the Roman Empire faced a similar crisis. Endless wars and a bloated bureaucracy drained the treasury. The emperors couldn't raise taxes enough to cover the costs. So they debased the currency. They mixed base metals like copper into the silver denarius. By the time of Emperor Diocletian, the currency was worthless. Inflation destroyed the middle class. The trade networks collapsed because no one trusted the money. Rome didn't fall to barbarians initially. It fell to fiscal insolvency. Britain, the post-war debt trap. Britain in 1945 ruled the world, but it was drowning in war debt. Its debt-to-GDP ratio was over 250%. The result? The pound sterling lost its status as the world reserve currency. The empire collapsed. Britain faced decades of austerity, rationing, and economic decline. The US is now approaching debt-to-GDP levels similar to wartime nations, but in peacetime, this is unprecedented. The most immediate danger is a sovereign debt crisis. The loss of confidence. The US dollar relies on one thing, the belief that the US can pay its debts. If that belief cracks, if creditors look at the $38 trillion number and decide the US is insolvent, they will stop buying bonds. Interest rates would skyrocket. The government would be forced to print money at hyperinflationary speeds just to pay the bills. The debt ceiling theater. We also face the risk of a self-inflicted wound, the debt ceiling. This is the statutory limit on how much the government can borrow. Every few years, Congress plays a game of chicken with this limit. A default, even a technical one for a few days, would shatter the global financial system. U.S. treasuries are the collateral for the entire world banking system. If they become worthless, trade stops, credit freezes, ATMs go dark. It would make the 2008 crash look like a picnic. How does the government keep borrowing without interest rates exploding? They use a mechanism we call the bond trick. Normally, if you borrow too much, lenders demand higher interest. To prevent this, the Federal Reserve acts as the buyer of last resort. When the Treasury issues debt that no one wants, the Fed creates digital dollars and buys the bonds. This artificial demand keeps interest rates lower than they should be. This is financial repression. It punishes savers, who get low interest rates, to bail out the government, the borrower. It is a transfer of wealth from your savings account to the government's deficit. It allows politicians to spend without raising taxes, while you pay the price through the erosion of your savings. Is there a way out? Mathematically, there are only 3 doors. Door 1, default. The U.S. simply refuses to pay. This is unlikely because it would destroy the global economy and American power instantly. Door 2, austerity. The government cuts spending to match revenue. This would require cutting Social Security, Medicare, and the military by 30-50%. It would cause a massive depression and social unrest. No politician who wants to be reelected will choose this. Door 3, inflation, the soft default. The government prints money to pay the debt. The debt number stays the same, $38 trillion, but the value of the dollar drops. You get paid back, but the money buys half as much. This is the path of least resistance. It is the path history suggests we will take. We will inflate the debt away. The crisis is here. The $38 trillion debt is not just a number on a clock. It is a ticking time bomb attached to the foundation of your financial life. The government has promised more than it can pay. It has borrowed from the future to fund the present, and now the future has arrived. You cannot rely on the system to fix this, because the system is the problem. The only protection is to understand the game, to own real assets, gold, land, businesses that cannot be printed away, to understand that the dollar is being sacrificed to save the debt. This is the financial coin historian. History has given us the warning. Now it is up to you to prepare.